Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
We begin this hour with stocks rising after results from Apple and Intel. Sebastien Page of T. Rowe Price saying he's a reluctant bull. We remain slightly overweight stocks versus bonds and our position for the stock market to broaden. However, we're starting to take profit. Sebastien joins us now for more. Seb, it's good to see you.
Great to see you.
Where are you taking profit, sir?
We're selling some stocks. We're going to remain still overweight for now. We're putting the proceeds in cash, so we're underweight bonds. And we're also selling some high yield. We're splitting the proceeds between cash and bank loans, which I think are attractive when rates surprise on the upside a little bit. They're kind of negative duration, if you will.
So 2 points to make here. One, why you're selling, and the second, why you're allocating the proceeds the way you're allocating them. Let's start with the why you're selling. Why are you selling? Why are you coming out of stocks just a little bit and selling down high yield just a little bit?
Okay, I'm going to give you the most consensus narrative, the most boring narrative.
Go ahead.
Okay,
It's Friday.
Yeah, we're confident in the economy. The economy looks just fine, but we're worried about valuation. And I watch surveillance every day, and everyone's on that boat. But valuations are expensive. And, you know, at 22 forward earnings, price earnings ratio on the S&P, it's high. In 2021, remember all the speculation we had? Does it start to you to feel a little bit like 2021? You know, in 21, someone bought a JPEG of a rock. Remember? 1.3 million. And when I say that to clients, they always reply that someone just bought a banana taped to a wall for $6 million. So they're starting to feel expensive.
What are you pointing to that's frothy, though? That's what I want to get into. Where do you see the froth right now?
Overall stock valuations? Overall. And I say overall because there's some stocks that are quite fairly priced in the world. So we're positioned for the market to broaden. But also credit spreads. Credit spreads really tight by historical standards.
What's fairly priced right now?
I think, look, if you look at the average stock in the world, you get a price earnings ratio of 14. That's actually the long run average for the average stock in the world. So that means that you have smaller caps, value, international small caps, EM, pretty much everything, but the technology sector, and there are parts of the technology sector that are also fairly valued. But it's all about the broadening. I think we're approaching peak concentration.
People have been saying this for months.
Yes.
Actually, they've been saying it for an entire year. John started off the conversation saying you're a reluctant bull. So is that what makes you reluctant? Just the valuations? Or are there other things you're concerned about, like policy uncertainty?
So I guess Lisa's not here today, so I need to play the bear narrative.
You've got to give us the doom and gloom, yeah.
Okay, look, I think long end rates are a real risk for those valuations. The curve is flat, you have tariffs, you have inflation, you have resetting higher on growth expectations. The direction of long end rates could be higher, and that could put pressure on those valuations. And then you have the usual lists: tariff, geopolitics. Often they don't matter until they really do. And Anne-Marie, my view is that geopolitics will really matter when you see an oil shock. And given the pressure that this new administration is going to put on Iran and where Iran is right now, I don't know where it's going to come from. I'm not a geopolitical analyst.
Sure.
But that's one of the risks that's out there.
Well, you've got to allocate capital, and that was the second point you made. As you sell down some of those equity positions into high yield, you're going into cash and not into the long end of the bond market, not into treasuries, not into a 10-year at 4.53. Do bonds not do what bonds used to do in the portfolio from your perspective?
Look, we still hold bonds. We have an overweight. We're short duration. Bonds will do what they need to do only if we get a growth shock. And by the way, I didn't name it as a risk. It's still a risk that some growth-related data disappoints. Remember back in August last year, we had one bad non-farm payroll print, and the market kind of freaked out a little bit?
So did the Fed.
It doesn't take much for a growth scare. I don't think that's the base case. In that case, bonds will diversify your portfolio. Rate shock, inflation shock, Bonds will not diversify.
You saw how the Fed responded to that unemployment head fake from the summer. They wanted to insulate the labour market. They cut interest rates 100 basis points. That was the starting gun for them. Things have changed a few months later. And I wonder from your perspective whether the threat of tariffs constrains the dovish bias of the Federal Reserve. Do you think it does?
Yes. I think it does because, at least in the short run, it's inflationary. We're talking about 25% on Canada. You get a ton of crude imports from Canada. I don't know how oil prices aren't reacting a bit more this morning, right? This is like 20% of oil consumption in the U.S. is derived from Canadian crude. So, yeah, I mean, that ends up being inflationary.
And when it comes to states landlocked in the Midwest, it's their only area where they actually get crude is from Canada. When you just mentioned earlier, we're never ready for a geopolitical shock, and it kind of shocks everyone when we get it. And you think that could be in the oil space. Could that be this weekend? Could it be Canada? Not something like Iran or Venezuela or Russia?
Well, the market doesn't seem to freak out about it yet, right? And a part of this is we don't really know what's going to happen to tariff ever. I mean, it could change on a dime, but I think once they're on, then it's harder to take them off. So I don't know. Anne-Marie, I think it's a small probability of a fairly sizable oil spike. When I asked a geopolitical expert recently, and I said, what could be the black swan in geopolitics in the oil market? And he said, well, once you start hearing that word in the news media, once you start hearing it on surveillance, Hormuz, which we haven't had any disruption there, but that is a large proportion of global oil flows. I'm kind of just, you don't know, it's a black swan.
Right. At the moment, Trump has been actually quite quiet about Iran and focused on other issues. You did mention something, though. Once you put tariffs on, they don't come off. And we saw that in the Biden administration. They kept Trump's first administration tariffs on, yet it added a little bit to inflation, but not enough. When we had an inflation spike under Biden, they didn't even remove them. So why is the Fed putting all this emphasis, potentially, in their concerns about policy going forward, what that does to inflation, on tariffs, if we've had them for years now?
Well, I think we're putting that emphasis. I don't think the Fed is coming out and saying we're watching the tariff game and we're adjusting our policy accordingly. We're reading.
Well, they did, though.
They
didn't assume, and then they did assume.
Right.
Part of that is because of trade realignment, right?
Yes. I mean, look, they have to react. They're data dependent. And I think right now the Fed is wait and see. So you're right. The first round of tariffs weren't inflationary. I think there are all sorts of effects of tariffs that we don't understand. You see what happened with Colombia. Right? It's a negotiation.
It's not straightforward.
tool.
I'm with you. I hear that all the time. But to Anne-Marie's point, the accusation leveled at the Fed right now is they seem to be more concerned with Trump tariffs than they were with Biden fiscal stimulus. And it's hard to get your head around that. Do you speak about that on the committee at all? What explains that?
I mean, we speak about all of it. And we debate all of it. Look, the Fed is looking at, or talking about looking at employment and inflation, and tariffs are a driver of inflation in the short run, could be a driver of inflation in the short run. I think it all boils down to this data dependency of the Fed. And if, to the extent that tariffs drive the data itself, then the Fed will adjust, right? So there's several layers of reactions in macroeconomics that the Fed will react to. But, you know, it's a treacherous environment, I think, for them it might not take much for the talk of rate hikes to start again.
Sebastien, we'll leave it there. Joining us now to discuss is Adam Posen, the president of the Peterson Institute for International Economics. Adam, good morning. It's good to see you.
Good to see you, John.
There is a constructive view out there, and it sounds like this. This is what I hear a lot from equity bulls. They say the approach to tariffs is transactional in nature. There's scope for significant negotiation, and the backdrop right now for the broader economy is pretty decent. Things are going to be okay. Is there a price we have to pay for the uncertainty in the meantime?
Yes. The price we're going to see not just in equity markets, but we're going to see in specific industries. We're going to see in energy prices going up. We're going to see in disruption to the U.S. auto sector. We're going to see in sharp retaliation from Mexico and Canada on specific industries. I don't mean to be vague by saying specific industries, but the point is it's about choke points. It's about things that are hard to replace. And the big thing, as studies we've done at Peterson Institute say, and which is intuitive, is there's some range over which you put on a tariff and everybody's like, okay, it's a price rise, it's annoying, we'll deal with it. There's another range where it's like you're imposing shortages like you did during COVID, that suddenly it becomes unaffordable or inaccessible to get certain things you need. And that's when you start getting big macro effects. So I agree, John, with the people who say the underlying strength of the U.S. economy is there. But this is frankly nuts. Canada and Mexico are our two largest trading partners. We're at peace with them. They're military allies, they're democracies. And our auto sector and our food sector are incredibly integrated. So this is going to hurt.
But Trump hates trade deficits, so he will do anything he can to try to bring that deficit down or maybe bring up negotiations for USMCA. What do you think is the underlying drive for these types of tariffs that, based on my conversations, I'd be more shocked if we don't see them happen tomorrow? Is it a negotiation tool or he wants to keep them on?
Emery, I think you're reporting your sense is right. We've been talking for months about expecting that the tariffs would really happen. I think it's much more likely the negotiations in the end go well with Canada than with Mexico. But the thing is, 25%, even if you exempt certain things, is an enormous number. This is, when people say, oh, the tariffs under Trump 1 were not inflationary, those were a couple percent in a few industries. This is very wide tariffs at a very high level with major retaliation.
So let's talk about the scope. Do you think oil is really on the table? Trump kind of flirted with it yesterday in the Oval Office.
We don't know. It doesn't make any sense to put oil on the table because then you're saying, okay, I want to buy more from Saudi or Russia. I just want to go back to your last point, which is right, which is how much is it negotiating versus keeping it on? The fear is, and I think what the market should fear, is that they're going to put on this across-the-board minimum of tariffs as part of the tax package. And then we're in an entirely different world.
Because it's a revenue raiser.
It's a revenue raiser. On net, it's probably bad for growth. And on net, it's not going to raise enough revenue. But that would be the justification.
Can you go through what you would expect in your base case as retaliatory? Because Trump is talking about potentially tariffs on Canadian crude. But for Canada, that would be the nuclear option for an export tariff.
Right. I mean, it's like when they complain, that, oh my God, China's going to cut us off from something. So imagine if Canada cut us off from oil. Think about, in the 1973 oil crisis when the Arab petrostates decided to cut the U.S. off oil. How is that good for the U.S.? I mean, it's destructive.
So, Adam, the Federal Reserve has got to prepare for all eventualities. You warned back in August they should prepare for that, and we've talked about this repeatedly. 6 months later, whatever it is, are you more comfortable with where the Fed is now compared to where they were going into the end of the year?
I'm more comfortable, but I'm not yet comfortable. I mean, the Fed has the luxury because, the fundamentals of the U.S. economy are quite good. And we've been getting good news on productivity, as we've also talked about. So the Fed has something of the luxury that it's not a crisis. They don't have to make up their minds now. But they keep having this inertia of saying, well, we're maybe not going to cut as much, but we're still going to cut. Now, on the fundamentals of the U.S. economy, the idea that they need to keep cutting was already, I think, arguably a mistake. So then comes this issue of tariffs. Do they play Hamlet and agonize, oh, is it a first round one-off effect? And we got to wait to see whether it goes beyond oil or beyond autos? Or do they say, hey, in a world we're close to full employment, there's pricing power, we're creating shortages.
Do you think there is pricing power? You don't think that corporations will have to just stomach this and hit margins?
I don't think so. I mean, the evidence is not the so-called greedflation. That was always a myth. But the evidence is not every industry, but most industries, the companies do have pricing power. I mean, when the economy's growing well over 2%, people are buying. We had an inventory correction. Otherwise, as Jason Furman's pointed out, the underlying strength of the U.S. economy is even stronger than the 2.3 number we had. The idea that there's no pricing power is just strange.
I think this conversation is important because it's difficult to sit here and say, I think the president will do X or Y this weekend. We've got to think about how inflation-prone this economy might be. When you think about sources of inflation at the moment, whether it be energy, labour, goods or services, what is it about the current state of things that you think this economy is more inflation-prone than maybe the Federal Reserve themselves might believe?
I think there's two categories, Jonathan. There's the pre-existing underlying economics, and then there's the Trump tariffs and other effects. On the pre-existing, the economy's inflation prone because financial conditions are not tight. They're just slightly tight in residential real estate and otherwise not. I think we're inflation prone because for all the talk about energy deregulation, we've seen how that's actually not a major determinant of inflation, right? Energy prices came down enormously in the last year of the Biden administration, and that wasn't enough to make up inflation. And we're inflation prone because the Fed hasn't lost huge amounts of credibility, but we're not down to target, and it is a few years later, and the memory of inflation is very strong. That's the fundamentals. Then on Trump, we've just talked about tariffs. Again, in theory, you could have a tariff that's just a price shift, like anything that's not Canadian to Mexican becomes relatively cheaper. But in practice, it's going to be experienced as inflation, and then people will want to catch up with prices and wages. But also, the anti-migration stuff, leave aside the human rights, the anti-migration stuff is partly recessionary, partly inflationary, because it creates shortages of labor in certain industries like home health care, residential construction, food harvesting, that native workers, documented workers don't want to do. And then you've got potentially, and this is going to be a lag, this is a few months down the road, very large tax cuts. And even if as Anne-Marie rightly says, you get some revenue from the tariffs, it's nothing to compare to the size of the tax cuts. So if you're the Fed and you're not just supposed to be reacting data dependent, but you're actually supposed to be looking at the forecast, it's very hard for me to understand why they're not pivoting more.
Just quickly, your base case is the next move's a hike and not a cut?
My base case remains that by September they'll be hiking. They may make a further mistake and cut once more. I hope not. But my base case is by September they'll hike.
It's quite a call, but you've been making it for quite a while. I appreciate it, Adam. Thank you, sir.
Thank you.
I imagine it's not the call you wanted to make either. Adam Posen there of the Peterson Institute. Let's turn back to the markets. Tech stocks leading gains this morning after a week of mixed earnings and news of China's DeepSeek AI breakthrough. Nouriel Roubini of NYU Stern and Hudson Bay Capital taking a bullish stance, posting on X earlier this week, in my modest opinion, the DeepSeek surprise is counterintuitively over time bullish for US and global stocks, as it is another positive global aggregate supply shock that increases US and global potential growth and makes exponential AI even more exponential. Nouriel joins us now for more. Nouriel, always good to see you, buddy.
Great seeing you, John. Good morning.
Let's pick up on that theme. Why do you think this is good news? And do you believe it is the real deal? Export compliant only costs $5-6 million?
No, of course, in spite of the restrictions, probably got more GPU, NVIDIA and otherwise. They didn't use 5K, probably 100,000. R&D costs were much more, and so on and so on. Still, it's not a 20x improvement, maybe it's a 2 or 3x. But my point was that if this is true, even to a 2-3x extent, is one of the biggest total factor productivity increases in human history, literally, and should be increasing potential growth, not just in China. The reinforced learning can be used by everybody's open source, so everybody's going to use it. And it's going to increase also not only the productivity of those who are producers of AIs, but more importantly of the consumers of AIs. So if it's really true, and I think it's an iterative process, we all learn from each other, we all distill from each other within the US, between China and US and others, it increases the fact that AI is going to change the world for the better. There'll be a significant increase in potential growth in the United States and also globally. So over the medium term, this should be actually positive for US and global stock markets, not negative. So the reaction, I think, initially on Monday was totally excessive. And the fact that now there's been some retracing over the week as people are digesting this news and saying this is not the shock that we thought it was.
Positive for stocks, positive for the economy, for economic growth. Do you think it's positive for society?
Well, there's been a huge debate about what are the risks of AI as opposed to the benefits of AI. I think in part is a political and philosophical question. We know misinformation, disinformation, risk of increased cyber warfare, eventually risk to humanity and so on. But I would say on net, AI, like any other technological innovation, is going to lead to an increase in both productivity growth, potential growth, and human welfare. We may be able to live until not 90, 100, 120. longevity, health, you name it. So it's a benefit to society overall. And there are side consequences and problems and risk, and we have to manage them. And I think that the regulation of AI is going to be very complicated. Probably like the internet, we're going to do it too little, too late, and then we're going to realize there are some mistakes.
If I clipped what you just said and used some AI and took out some words and replaced AI with globalization, weren't we saying the same thing a few decades ago?
Well, globalization that is being bashed right now by everybody led to an increase in huge amounts of welfare for billions of people around the world, 2.5 billion Indians and others and so on, and even in advanced economies. So trade and globalization and technology are the same thing, is a ways of increasing productivity growth. There'll be a backlash, but I think that, and the backlash is going to come on AI, is that there'll be massive amounts of job displacement. Job augmentation will be initially, but then job substitution and replacement is going to be. And then there'll be UBI or other things to resolve it.
Will AI do to services what globalization did to manufacturing is a question I keep going back to. How many people are going to be satisfied with just UBI? I don't want to sit at home, do nothing and get paid by the government. We aspire as human beings to be better, to improve, to climb the social ladder. A lot of people
Let's put it this way. In a world of scarcity, of course, the dignity of life was to provide for yourself and for your family and go and look for water, food, shelter every day. In a world in which scarcity becomes less of a constraint, we have to produce less because the robots are going to do it and we can consume more. You're right that you guys saying what's the meaning of life in that situation. It's a philosophical question. And John Maynard Keynes in the 30s said, once we get this technology innovation, everybody's going to work only 10 hours rather than 60 hours, and we'll become poets, artists, creators, and whatever not. Maybe the nature of life is going to change. Maybe with AGI, we have to merge with the machine, because if we don't merge with the machine, they become hyper-intelligent and we become obsolete. And then there's going to be a new species. It's not going to be Homo sapiens, but Homo roboticus. But it's going to take decades. Those are important philosophical questions, but I will argue provocatively that 20 years from now, potential growth probably could be 8%, and unemployment rate could be 80%. We are going in that direction over time, and then we have to manage the consequences. And UBI, by the way, cannot be only national, because the winners and losers are not going to be only internal, but also across countries. Those who innovate get better off compared to those who don't innovate. Can we have a system of global governance that has cross-border UBI? I mean, those are big issues.
Global governance.
Well, a form of global governance, cooperation. We have international...
You can't even, if you use DeepSeek today, you can't even find out things about the Chinese Communist Party, things like Tiananmen Square. How are we supposed to have global governance with these kind of countries?
I think what's going to happen is that over time, given the geopolitical divisions between US and China, the world is going to be divided in two. There'll be a group of countries, US, with its friends and allies, and others in the global south who prefer the economic, monetary, social, political, geopolitical system of the US and the West. Some in the global south are going to go with us, and there'll be others going to go with the model of China. Both model economic, trading, state capitalism, geopolitical, security, BRI, technology, and whatever not. And there'll be a split world. But within the West, if there are, and those friends and allies, if there are winners and losers within countries or across countries, we'll have a system of transfers. I mean, we've been subsidizing the defense of our friends and allies from Asia to Europe for now 80 years, because it was in the global interest of the United States. So if we need to do global UBI across friends and allies and others part of our system, we're going to do it. But that's the world we're going. And China is doing the same thing. We have to subsidize our friends, and they'll do the same.
I'm petrified of the world you describe. I want nothing to do with it.
And Lisa's not here, and it's gone very existential. Lisa's not even here, and it's gone very existential, this conversation. When it comes to this idea of, all right, global regulation on AI, do you think Trump will use AI right now in the next 4 years as a bargaining chip as he tries to work on global realignment when it comes to trade?
He will. Actually, Biden, right before he left in early January, had his new AI diffusion rule that divides essentially the world in three groups of countries: Tier 1, Tier 2, Tier 3. If you are part of the global technological order of the United States and you accept all the rules and the security, you have access to unlimited amounts of advanced chips of NVIDIA and others. You have access to all the AI models. You can have access to building the data center, and you're part of our own technological sphere. And we set the rule of essentially who is in that type of tier one. We are deciding unilaterally. It's not a question about regulating AI, but who is our friend and ally. And even within NATO, there are only so far 18 countries that qualify for tier one. Not all NATO countries do. Of course, the countries in the big Five I are part of it. Some of the other NATO members. Plenty of countries are not. Tier 2 is mostly the global south and everybody else. Yep. And of course, China, our rivals, are tier 3 and so on. So the US is going to set the rules of the global technological order. And it's going to do it totally unilaterally. And it's either you are with me, because I'm setting those technologies, and I'm the one who's advancing those technologies, then you can use the chips, you can develop the application, you can do the data center with me, or otherwise you're in the doghouse.
I wanted to squeeze in one more question. The Europeans would be deeply upset. Europeans would be deeply upset with this conversation, I'm sure.
No, but they already accepted it. The same thing happened with data centers, right? They tried to find an alternative. They were not successful. And the hyperscalers are providing those data centers in Europe. And maybe they are technically in Europe, but they're controlled by AWS and Microsoft and you name it.
I'm against the clock.
That's already the world we're in.
I wanted to squeeze in a word on Stephen Moran, just quickly.
Yeah.
Worked alongside him at Hudson Bay Capital, who you represent this morning. Published a really interesting paper at the end of last year about activist treasury issuance, ATI. Yeah. Now, he's in power now. He's in the White House, working alongside Donald Trump as an economic advisor. Yeah. What's going to happen now? If you believe that Janet Yellen, the former Treasury Secretary, was issuing treasuries actively at the front end to have different objectives, how do we unwind that this time around? Do we even try?
Well, Scott Bessent in his confirmation hearing was asked about this, and he already said that effectively, given the impact on long-term interest rates, if you phase it out right away, it's going to be a shock to long bond yields already going higher. In our paper, we estimated the shock could be for the next 2 or 3 years at least 50 basis points. So they know that. So they're going to have to wait and phase it out, one, gradually, and two, in their view, when bond yields are going lower, either going lower because maybe growth is slower or because inflation is lower. So they'll have to opportunistically, gradually phase it out over time. But it's not going to happen overnight, and they've already said so.
Nouriel, it's always good to see you, sir. Lots to think about. Scaring me about the future. Nouriel Roubini of NYU Stern and Hudson Bay Capital. I want absolutely nothing to do with that.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.